Welcome to the Tesla Daily News podcast for December 5th, 2025. I'm your host, breaking down the latest developments shaping Tesla's stock, business, and future. Let's kick off with the numbers. Tesla closed yesterday at approximately $454.53 per share. That's up from the prior close of $446.74, an increase of nearly 1.7% on the day. Investors are breathing easier as the bullish momentum continues. In today's podcast, we'll cover new breakthroughs in battery production, European sales challenges, big regulatory shifts in the U.S. auto market, a warning sign out of Ford, advances in self-driving tech, and the accelerating robotics gold rush. Let's get started. First up, Tesla claims it has achieved a revolutionary breakthrough in battery production, potentially reshaping the cost structure for electric vehicles. The company announced it's now converting waste carbon dioxide from its factories into soda ash, a key ingredient in battery making. By recycling CO2 emissions on-site, Tesla aims to cut raw material costs and boost its vertical integration. If this breakthrough leads to lower battery prices, Tesla could unlock new affordability in future models, pressuring competitors and supporting margin expansion. For investors, this pushes Tesla's growth story beyond vehicles, highlighting manufacturing innovation as a driver of long-term value. Bottom line, watch for analyst upgrades if production scaling holds up in coming quarters. Turning to European demand, Tesla's grip on the continent loosened notably last month. New data shows Tesla's registrations across Europe dropped more than 36% year-over-year in November, even as overall EV adoption in the region rose. In some major EU markets, Tesla sales plunged nearly 50% compared to the prior year. The lone bright spot has been Norway, which temporarily prevented an even steeper regional decline. This trend signals intensifying local competition and potential pricing or inventory challenges for Tesla in Europe. Investors should track how aggressively Tesla responds to regain share and whether margin pressure mounts in overseas markets. This could influence analyst expectations for 2026 earnings. Meanwhile, big regulatory changes are coming in the U.S. President Trump just proposed rolling back stringent fuel economy standards set by the previous administration, the rules that were set to accelerate electric vehicle adoption by making combustion engines less attractive. With these standards now in question, legacy automakers could find it easier to sell gasoline vehicles, reducing the urgency for consumers to adopt EVs. While auto industry CEOs, including from Ford, welcome the move, some analysts warn this could slow Tesla's addressable market growth in the near-term U.S. market. Investors should consider the ripple effects on long-term EV demand projections and the competitive landscape if these policy shifts become law. Speaking of Ford, there's a key warning for Tesla shareholders today. Ford reported a dramatic collapse in its U.S. EV sales for November, with year-over-year deliveries falling sharply. While Ford's total U.S. vehicle sales were only down slightly, the bulk of the decline is coming from EVs, highlighting continued softness in mainstream demand and fierce pricing pressure. Although Tesla isn't seeing the exact same sales drop, this signals possible headwinds for premium EVs and may increase concerns about industry-wide overcapacity. Investors should watch for Tesla's next delivery report to see if this is a broader trend or an isolated Ford issue. On the technology front, Tesla is doubling down on intelligent driving features even as global EV sales growth moderates. Reports from the 2026 Tech Forum show Tesla shifting significant resources toward autonomous and intelligent driving, vying with BYD to lead the next phase of competition. Technical upgrades, software updates, and visible improvements in full self-driving supervised features signal Tesla's intent to stay ahead despite slowing vehicle sales. For the stock, a successful push into autonomy could open new high-margin revenue streams and justify premium valuation multiples. The takeaway: pay close attention to regulatory progress and real-world FSD deployment milestones. Finally, a surge in robotics stocks and new government interest have caught Tesla's and Wall Street's eye. Reports indicate the U.S. administration is preparing an executive order to supercharge the nation's robotics industry, potentially triggering investment and demand across the sector. Shares of household robotics firms soared on the news, with investors speculating that Tesla's own robotics division, think Optimus and AI-driven automation, could become the next growth engine. If federal support accelerates the adoption of advanced robotics, Tesla could benefit from first-mover advantage, further diversifying its business beyond cars and energy. To wrap up, Tesla's stock continues its upward march, supported by manufacturing innovations and bets on autonomy and robotics, but faces real headwinds in Europe and risks from shifting U.S. policy. For investors, the focus should remain on delivery numbers, margin trends, and how quickly business lines like robotics and FSD can scale. Tomorrow, keep your eyes peeled for new analyst notes on European demand and updates on federal EV policy. If you want Tesla news and stock insight daily, don't forget to subscribe, visit our website, and join us again for tomorrow's episode of the Tesla Daily News Podcast.